Hi everyone. Welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence.
In today's video, let's take a look at how Ray Dalio compares the game of Monopoly with the stock market, the economy, and the banking system. This comparison provides really good insights and learnings on how our behavior tricks us at various stages of investing and economic cycle. Using Monopoly game as an analogy, Mr. Dalio shares about what happened during the 2008 financial crisis. He also covers how the crisis could have been avoided if various groups of people understood their actions and behaviors. Let's dive in. In his 2008 letter to shareholders, Mr. Dalio talks about the Monopoly game while reflecting on the lessons learned in that year. In the year 2008, we had the Great Financial Crisis, which is considered the worst crisis after the Great Depression of the 1930s. In essence, it was caused by predatory lending by companies targeting low-income homebuyers, excessive risk-taking by global financial institutions, and the bursting of the U.S. housing bubble. According to Mr. Dalio, the crisis was a reflection of human nature as no external shocks caused it. The crisis was completely caused by people operating in a manner consistent with their individual natures and together in ways typical of group dynamics. Mr. Dalio continues by sharing that if you understand the game of Monopoly, you can pretty well understand what happened to the economy and to people's financial circumstances in 2008. Early in the game of Monopoly, people have a lot of cash and few hotels, and it pays to convert cash into hotels. Those who have more hotels make more money. Seeing this, people tend to convert as much cash as possible into property in order to profit from making other players have to give them cash. So, as the game progresses, more hotels are acquired, which creates more need for cash. The cash is needed both to pay the bills for landing on someone else's property with lots of hotels on it and to continue to buy more hotels. When people are caught needing more cash, they are forced to sell their hotels at discounted prices. So, early in the game, property is king, as you need to build your portfolio of hotels, and later in the game, cash is king, as you need that to sustain playing. Those who are best at playing the game understand how to hold the right mix of property and cash, as this right mix changes as the game progresses. Now let's imagine how this Monopoly game would work if we change the role of the bank so that it can make loans and take deposits. Players would then be able to borrow money to buy hotels. And rather than holding their cash idly, they would deposit it at the bank to earn interest. This would provide the bank with more money to lend. If Monopoly were played this way, it would provide an almost perfect model for the way our economy operates. More money would be put into hotels sooner as players could borrow money to buy hotels. Also, the amount owed to the bank would quickly grow to multiples of the amount of money in existence. At the same time, players buying and holding hotels will have a shortage of cash because they are quickly using up everything to buy hotels, so the cycles would become more pronounced. Also, both the bank and the players who saved money by depositing it in the bank will get into trouble when the players who borrowed the debt are not able to pay back, and at the same time the depositors are asking the bank to pay them back. That's what happened in 2008. According to Mr. Dalio, if the game of Monopoly were played with the bank operating this way, and more kids played it from an early age, we would have more astute investors, businesspeople and bankers, and, as a result, we would have less dramatic economic cycles. Mr. Dalio goes further. If we wanted to train our kids to have a really rich appreciation of how the economy works, we would have to make our Monopoly game only slightly more complex by allowing the bank to print money. If the bank could print the money, it would certainly do so when there was a cash shortage. This is when people need a lot of cash, when they can't pay their debts, when they are selling their hotels, and when banks struggle to come up with enough money to meet demand, because the players aren't servicing their debts. Kids would soon learn that, all things being equal, printing more money causes its value, the currency, to fall, and the increased money supply to buy hotels drives their prices up. But, if the bank prints more money when the demand for it is high, and there is a shortage of money when hotels are being dumped, and hotel prices are falling, then the currency would not fall in value and the prices of hotels would not rise, because the increased supply of money would simply negate the effects of the shortage of it. That's also what happened in 2008. In other words, in the years immediately prior to 2008, players in the economy took on a lot of debt to buy assets at high prices. So, in 2008, the game progressed to the stage where cash is in short supply, there are debt problems, and assets are written down or liquidated. Naturally, the central bank printed a lot of money, but this didn't cause its value to fall or inflation to rise, because this increased supply of money negated some of the effects of the shortage. We'll share more such videos with insights from Ray Dalio in the coming days.
For now, that's it from us. Hope you enjoyed and learned from this video. Smash that like button and subscribe to receive more videos on memos and write-ups from top investors. Thanks for watching.